In January 2026, I wrote something that made a lot of people in Silicon Valley uncomfortable. I said that artificial intelligence is in the early stages of a bubble. Not that AI is not real. It is real. Not that it will not transform the economy. It will. But that the financial structures being built around it, the valuations, the debt, the capital commitments, are exhibiting the early characteristics of every bubble I have studied in 50 years of managing money. A top Bank of America credit executive described the current AI build-out as unlike anything anyone in the business for 25 years has seen. He meant it as a statement about scale. I read it as a statement about risk. $3 trillion. That is the estimated cost of the AI infrastructure build-out through 2030. $3 trillion in data centers, chips, cooling systems, power generation, fiber optic networks, and the organizational overhead required to deploy all of it. And here is the number that should concern every investor. A significant portion of that $3 trillion is being financed with debt. Not equity, debt, borrowed money. And borrowed money requires two things to function. It requires interest rates that make the borrowing affordable, and it requires the continuous willingness of lenders to provide it. Both of those requirements are now under structural threat. And that is what I want to explain today, because the intersection of the AI bubble, the debt crisis, and the capital war I have been describing is producing a configuration that I have seen before. I saw it in 2000, I saw it in 2008, and I saw the aftermath, which in both cases was devastating for the investors who did not understand the mechanism and enormously profitable for the investors who did. Subscribe now. Let me start with how the machine works, because I always prefer to start with the mechanism rather than the conclusion. The credit system is very much like a circulatory system. Credit flows through the economy the way blood flows through the body. When credit goes to productive uses, to investments that generate income sufficient to service the debt, the system is healthy, the economy grows, asset prices rise, everyone benefits. But when credit goes to speculative uses, to investments that depend on continued price appreciation rather than income generation to justify the borrowing, the system becomes fragile. The debt service payments start to squeeze out other spending. And when the squeezing becomes severe enough, the circulatory system develops the equivalent of plaque. The flow slows. And if it slows enough, you get a heart attack. The AI build-out is currently absorbing credit at a rate that is historically unprecedented outside of wartime. Microsoft, Amazon, Google, and Meta have collectively committed more than $300 billion in capital expenditure over the next 3 years for AI infrastructure alone. That number is being financed through a combination of corporate cash flows, bond issuance, and bank lending. Now here is the question I have been asking. What happens to that financing if the capital war I described escalates? What happens if foreign buyers of United States debt, who have been the primary source of cheap capital for American corporations for decades, reduce their purchases? What happens if the cost of borrowing rises not because the Federal Reserve raises rates, but because the market demands a higher risk premium for holding dollar-denominated debt? The answer is that the most capital-intensive, most debt-dependent sector in the market becomes the most vulnerable. And right now, that sector is technology. The S&P 500 information technology sector represents 32% of the entire index, 1/3 of the value of the most widely held equity benchmark in the world is concentrated in a single sector that is currently making the largest capital commitments in its history, financed significantly with debt, during a period when the cost and availability of debt is under structural threat. I want to be precise about the historical comparison because the pattern I am seeing now has appeared twice before in my career, and both times the outcome was severe. In 1999 and 2000, the telecommunications industry was building out the internet infrastructure, fiber optic cables, switches, routers, data centers. The technology was real. The internet was going to transform the economy. Both of those things were true. What was also true was that the companies building the infrastructure were doing so with borrowed money at valuations that assumed the growth would continue indefinitely, and the market for that debt froze when interest rates rose. The junk bond market seized up. Companies that had been borrowing to build found they could no longer borrow. And the stock prices of those companies, many of which were among the most admired in the market, fell 70, 80, 90%. The technology survived. The internet transformed the world exactly as predicted. The investors who bought at bubble valuations with leverage lost everything. The investors who waited for the bubble to burst and bought the survivors at reasonable prices made extraordinary returns over the following decade. In 2008, the same pattern played out in real estate. The underlying asset was real. Houses have value. Mortgages are a legitimate financial instrument. What was not legitimate was the leverage, the complexity of the derivatives built on top of the mortgages, and the assumption that the value of the underlying asset could only go up. When that assumption was challenged, when mortgage-backed securities turned out to be riskier than the market assumed, the entire credit system froze. Companies that had nothing to do with real estate saw their access to capital disappear overnight. The AI bubble has the same structural characteristics. The technology is real. The transformation will happen. But the financial structures being built around it, the valuations, the debt, the capital commitments, are exhibiting the same patterns that preceded the 2000 and 2008 crises. Let me be specific about the mathematics, because I think most investors are not doing the math on what these AI capital commitments actually require to justify current valuations. Microsoft dropped 23% in the first quarter of 2026, not because AI stopped working, not because Azure revenue declined, because the discount rate, the rate at which future earnings are brought back to present value, rose when the Federal Reserve signaled that rate cuts were off the table. When you pay 35 times earnings for a company and the discount rate rises by 100 basis points, the present value of those future earnings falls mechanically. That is not an opinion about Microsoft's business. That is discounted cash flow arithmetic. The S&P 500 information technology sector represents 32% of the entire index. These are the highest multiple stocks in the market. They are the stocks most sensitive to changes in interest rates, and they are simultaneously the stocks most dependent on the continued availability of cheap capital to finance the infrastructure build-out that justifies their valuations. When rates rise or fail to fall as expected, both of those dependencies work against the investor simultaneously. Now, here is what most people miss about the interaction between the AI bubble and the debt crisis. The $3 trillion in AI capital commitments is not being spent in a vacuum. It is being spent in an economy where the government is simultaneously borrowing $1.9 trillion per year to finance its deficit. Both of these enormous capital demands are competing for the same finite pool of lenders and investors. In a normal environment, with free-flowing global capital, this competition is manageable. There is enough capital in the world to finance both government deficits and corporate investments simultaneously. But in a capital war environment, where foreign buyers are reducing their purchases of dollar-denominated assets, the pool shrinks. And when the pool shrinks, the competition intensifies. Interest rates rise, the cost of capital increases, and the marginal investment, the one that only makes sense at low interest rates, becomes unprofitable. Which investments are marginal? The ones with the longest duration, the ones that require the most years of future cash flows to justify the upfront expenditure. AI data centers that will take 5 to 7 years to generate a return on their construction cost are precisely the kind of long-duration investments that become most vulnerable when the cost of capital rises. And the variable that makes 2026 different from both of those previous episodes is the capital war. In 2000, foreign capital was flowing freely into the United States. In 2008, foreign capital was flowing freely into the United States. In 2026, foreign capital flows into the United States are under structural threat for the first time in 80 years. If foreign buyers reduce their purchases of American debt, interest rates rise. If interest rates rise, the cost of financing the AI build-out increases. If the cost of financing increases, the projected returns on those investments decline. If projected returns decline, the valuations that are currently assigned to AI companies become harder to justify. And if valuations compress while earnings are under pressure from higher financing costs, the result is what the market calls a correction and what I call the end of a bubble. Goldman Sachs has forecast that the S&P 500 will deliver approximately 3% annual returns over the next decade. Vanguard is projecting approximately 5%. Those forecasts are not bearish. They are the mathematical consequence of starting from elevated valuations in an environment of higher interest rates and slowing growth. But 3% annual returns from the S&P 500 over the next decade, if that forecast proves correct, means that the investors who are concentrated in American equities, and particularly in American technology equities, are accepting a return profile that barely keeps pace with inflation. And if the capital war accelerates and the dollar weakens, the real returns could be negative. Now let me tell you what I believe this means for gold, and for the broader asset allocation question that every investor should be asking right now. Gold returned 65% in 2025. It outperformed the S&P 500 by 47 percentage points. That outperformance was not an anomaly. It was the market beginning to price in the structural shift I have been describing. When the dominant reserve currency is under pressure, when the fiscal position of its issuer is deteriorating, when foreign buyers are reducing their holdings, and when the central bank is constrained from acting decisively, gold benefits from all of those dynamics simultaneously. The AI bubble adds another layer to this thesis, because the capital that is being committed to AI infrastructure is capital that is not being committed to fiscal repair. The United States government is running a deficit of $1.9 trillion, while the private sector is simultaneously committing $3 trillion to AI build-out. Both of these capital demands are competing for the same pool of lenders, and that pool is shrinking because of the capital war. Something has to give. Either the AI build-out slows, which compresses technology valuations, or the fiscal deficit expands further, which weakens the dollar, or interest rates rise to attract capital, which increases debt service costs and makes both the fiscal and corporate debt problems worse, or the Federal Reserve monetizes, which inflates the money supply and devalues every dollar-denominated asset. Every one of those outcomes is positive for gold. Every one of those outcomes is negative for dollar-denominated financial assets at current valuations. I am not telling you to sell your technology stocks. I am telling you to understand what you own and why you own it. If you own technology because you believe AI will transform the economy, you may be correct. But being correct about the technology does not protect you from being wrong about the valuation. The investors who were correct about the internet in 2000 and wrong about the valuation lost money for a decade before the technology thesis played out. The mechanism that protects you is diversification. Diversification across asset classes. Diversification across geographies. Diversification across currencies. And a meaningful allocation to the one asset that has no counterparty risk, that cannot be printed, that cannot be frozen, and that has preserved purchasing power through every stage 6 transition in 500 years of recorded history. I wrote in my guidance for 2026 that gold was the best performing major market in 2025 and that most investors do not have an adequate amount of it in their portfolios. That guidance has not changed. The structural forces driving it have intensified. Let me be specific about what intensified means in terms of data. In 2025, the MSCI Emerging Markets Benchmark Index rose 33%. That is double the S&P 500 return. European markets outperformed. Asian markets outperformed. The dollar weakened against the basket of major currencies. These are not random fluctuations. These are the early manifestations of the capital reallocation I have been describing. When I look at the flows, I see something that has not happened in my 50-year career. I see a simultaneous shift away from the United States across multiple asset classes, multiple geographies, and multiple types of institutional allocators. Sovereign wealth funds diversifying, central banks diversifying, pension funds diversifying, private wealth diversifying. The direction of travel is unanimous, even if the pace varies. The AI bubble is accelerating this shift for a reason that most technology analysts are not discussing. The massive capital commitments to AI infrastructure in the United States are being financed at a time when the return on that capital is uncertain and the cost of that capital is rising. Meanwhile, the rest of the world is investing in productive capacity, in manufacturing, in resource extraction, in infrastructure that generates returns immediately rather than in 5 to 7 years. The emerging market investor who builds a solar panel factory has a customer today. The American investor who builds an AI data center has a projected customer in 2029. Both investments may prove profitable over time, but in an environment of rising capital costs, the investment with the shorter duration, the faster payback, the more immediate cash flow has a structural advantage. This is why capital is flowing away from the United States and toward emerging markets, not because of politics, because of arithmetic. The same arithmetic that is trapping the Federal Reserve is making American investments relatively less attractive than investments in economies with lower debt, lower rates, and more immediate productive returns. The AI transformation is real. The bubble built around it is also real. Understanding the difference between the two is the most important investment distinction you can make in 2026. And the protection against the bubble's eventual resolution is not to avoid technology entirely. It is to own enough of what survives every bubble in history, which is the asset that does not depend on any government's fiscal credibility or any corporation's debt capacity to maintain its value. Watch the credit markets. Watch the bond yields. Watch the foreign flows into United States debt. And understand that the most popular trade in the world, long American AI technology at any price, is the trade that depends most heavily on the capital war not escalating. Let me tell you what I am specifically watching for to determine when the AI valuation correction has run its course. Because there is a difference between identifying a bubble and knowing when the bubble has deflated enough to make the underlying assets attractive again. The first indicator is the high-yield credit spread. When the junk bond market starts pricing in default risk from companies that borrowed to build AI infrastructure, you will see it in the spread between high-yield bonds and treasury bonds. In 2000, that spread blew out to over 800 basis points before the correction found its bottom. In 2008, it exceeded 1,000. Today, that spread is elevated but has not reached crisis levels. When it does, it will tell you that the credit market has finished repricing the AI debt and that the next phase, the recovery phase, is approaching. The second indicator is what I call the capitulation trade. In every bubble I have studied, there is a moment when the last believer sells. When the fund manager, who was most bullish on the sector, throws in the towel and reduces exposure. When the retail investor, who bought at the top, finally takes the loss. That moment of maximum pessimism in the bubbly sector coincides historically with the bottom. The third indicator is the gold to technology ratio. When gold is outperforming technology by the widest margin in a given cycle, the market is telling you that it values stores of value over stores of growth. When that ratio begins to narrow, it tells you that risk appetite is returning and that technology, now at lower valuations, is becoming attractive to institutional capital again. I am not telling you that these indicators have triggered. I am telling you to watch for them, because the difference between losing money in a bubble and making money from a bubble is not whether you avoid the bubble entirely. It is whether you understand the sequence well enough to buy what the bubble overpriced after the correction has brought it back to reasonable levels. The investors who bought Amazon at its dot-com peak of $90 lost 75% of their investment and waited 7 years to recover. The investors who bought Amazon at its dot-com bottom of $6 made one of the greatest investments in history. The same company, the same technology, the same thesis, completely different outcomes based entirely on valuation and timing. The AI companies that survive this cycle, and many of them will, may offer similar opportunities, but those opportunities will not appear at current valuations. They will appear after the credit market has repriced, after the bubble psychology has broken, after the capital war has forced the cost of financing high enough to separate the companies with real earnings from the companies with real stories. In 50 years of watching markets, I have learned that the trades that depend on nothing going wrong are the trades that produce the most catastrophic losses when something does.